Joining us now is Kyle Rodda, the market analyst at IG. Kyle, good morning to you. Thanks as always for joining us. So let's talk about the RBA today. Is there any chance at all of rates being cut?
Well, I mean, I suppose the short answer is yes, there's a chance that the RBA could be cutting interest rates today. You always look at market pricing around these sorts of events and the spectrum of possibilities. The market's pricing in a probably 10% probability that the RBA will cut at this particular meeting, not a very significant one. So it sort of seems that largely market participants are going to be using this particular meeting to try and gauge when the RBA will cut next. Obviously, we spoke last week after RBA Governor Philip Lowe's discussion on unconventional monetary policy tools and made that sort of illusion that the effective lower bound, which is the cash rate, which if rates are lowered beyond has no effect anymore in terms of monetary policy stimulus, that rate's around 0.25%. So the last week or so has very much been characterised by market participants expecting that next year the RBA will cut twice to 0.25%, and this meeting's being judged on the basis that this will set up the foundations of working out when that next cut will be, because right now the market's expecting that should come in February and that we will see a cash rate next year of 0.25%. So no cut today, but it's very interesting for what it all means for next year.
Yeah, the market's still expecting February, so we'll keep an eye on that. Kyle, when the market opens today, do you expect there to be a bit of a dip off the back of what seems like a bit of a broadening trade war? Trump now putting tariffs on two South American countries that were previously exempt. Australia was one of those countries in 2018 that was exempt from steel and aluminium tariffs. We've escaped this time round, but is it perhaps a bit of a sign that we may not escape it forever?
That's possibly the case. I mean, it very much depends on diplomatic wrangling between, obviously, our administrators, our government, and their relationship with US President Donald Trump. I suppose, in terms of how we're expecting the ASX 200 just to open up this morning, we're forecasting, in terms of futures markets, for a fall of about 1.5%, quite considerable. And that's because of two stories. There was that story overnight that the Trump administration would be hiking steel tariffs on Argentina and Brazil. But there was also some interesting commentary coming out from an advisor to the Trump administration yesterday, Wilbur Ross, who suggested that tariffs on China could still be hiked yet, and alluded to the December 15 deadline, or what he called a deadline, where tariffs are expected to be hiked or scheduled to be hiked next, as being a kind of quasi deadline, like I said, for a trade deal that needs to be, I suppose, struck before that point in time. So we're seeing a lot of confidence being sapped out of the market today. Don't be surprised if the ASX 200 falls quite considerably. Like I said, futures markets are pointing to about a 1.5% fall. And again, this is all because tariffs and the trade war are back in the headlines again. And we're getting a little bit nervous in the market in the lead up to what's actually a pretty big 2 or 3 weeks.
What about, Kyle, the productivity numbers? There's a story in this in the Financial Review today, the worst in 25 years. I mean, significant, isn't it?
Yeah, it is. And I suppose it's a story that crosses a lot of developed markets, actually, is that productivity across multi-decades has been on a decline. And it's something that policymakers are really trying to wrangle with in terms of trying to avoid what this notion of secular stagnation, that as we move into the future, our demographics change, and also policymakers lose some of the tools available to them to stimulate the economy, that we could be heading to a period where productivity growth is rather slow, growth just in general is rather slow, and we again head to this period of something that is called secular stagnation, where investments yield very low returns and growth goes down to levels much below trend. So it's not something that's necessarily new, but something that is definitely something that policymakers the world over are wrangling with, and we're seeing this play out now in central bank policy in particular. Interest rates are very, very low as monetary policy makers try to stimulate growth again and boost productivity. But we're also seeing governments worry about this too, because of course there is long-term implications, particularly say in the Australian experience, as the demographics shift, our population grows older. If productivity slows, it makes it very difficult to sustain the welfare state and support a robust economy. So keep looking at those numbers. Of course, the shorter-term implications aren't huge, but in terms of the structural factors in the global and local economy, productivity is certainly one to watch because it has been in a downtrend for a very long time.
Yep, certainly politicians are watching that. Also, I think there'll be a lot of interest in what house prices are doing. The biggest monthly jump, and I think 16 years or something like that, 2.7%. Does this show us, Kyle, that the RBA and its monetary policy and the 3 cuts we've seen this year is not quite having the effect it hoped it would, and instead of spending money in the lead up to Christmas, people are just putting that money into their mortgages.
Yes, so when you look at monetary policy measures, and it's probably the stark realisation that the RBA has come to, and particularly central banks overseas, and obviously these trends all move in lockstep, and that's why I allude to that, starting to realise, and this is why we spoke about a couple of weeks ago, why central bankers are starting to call out for fiscal policy measures, is because the transmission mechanism from monetary policy largely works by inflating asset prices, and that's boosting, obviously in Australia, house prices in particular, but overseas financial assets in the stock market, etc., etc. Now, what we seem to be seeing in the short term in the Australian economy is that, like you said, these rate cuts are being used to pay down debt on very high levels of private debt in the Australian economy, rather than going out to spend and invest, or they're going back into financial assets, or potentially pushing up, say, house prices as investors move back into that space in particular. So the concern there is effectively that, one, the money that's being freed up from interest rate cuts isn't going back into the real economy and stimulating growth, and that you also have these risks of greater financial stability too, as obviously asset prices increase for those who don't want to pay down debt, who want to go and buy stocks and invest in housing. So this is kind of the core concern for the RBA at the moment. That's why there has been a lot of calls for fiscal policy from the RBA and central bankers around the world. And I suppose tying it back in today, why it'll be very interesting that this RBA meeting falls the last of the year in the context of trying to work out what the RBA will do next year, because they have less bullets in the gun, it would seem. They need a little bit more support from governments, and if they don't, well, they're going to embark on extraordinary monetary policy measures, which could exacerbate the situation, have adverse outcomes as well. So it's a very complex situation at the moment, but one that at the moment doesn't seem to be having the desired effects, but it's a wait and see set of circumstances.
Okay.